Exela stock has been the center of much conversations as of late, and many people are wondering if they should buy more, sell what they have, or stand on the side and wait for a better timing. As the market is still very volatile at the moment, we should always be careful about which stocks we pick, what would be the exposure and the timing of the positions we take. Over the past few days, the price action of Xela has brought the stock to around 34 cents, before stabilizing around 27 cents. Looking at the short-term price trends of Exela, it seems like so far the market is relatively robust to hold its short-term support levels. The recent low of 1 cent has not been tested since March, and we're now looking for catalysts to get higher in an overall challenging market condition. Another aspect to look at is the long-term tendencies for Exela, and so far it has been under a lot of sell-off pressure from the market, very likely as a result of the peak that happened back in 2021. If things looked fairly straightforward in the short-term perspective, they are relatively less so in the long term, regarding whether you should enter in the position now. The support levels for Exela are much lower, and in fact, the reality is that the company may not have enough history to look back that far, since for the majority of its existence, its price remained at a much lower and constantly so level. Now, let's also take a look at the technicals. The trading volume of Exela has recently been 16 million shares, compared to the average of 23 million shares. Over the previous 52-week period, its price fluctuated between 26 cents and $5.45. The market cap of Exela is currently at $140 million versus the enterprise value of $1.5 billion. The difference between the market cap and its enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient for many other companies. One key element to note about the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that a company can generate more profit or to have more growth than another company, partially because it has a good management, a stronger brand recognition, a bigger following online, and others. It is basically what makes this company unique compared to the rivals. In other words, it's not a tangible asset that companies may use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, as the enterprise value is often less reactive than the market cap in volatile situations. If the company goes to liquidation, anything that's intangible would likely be gone, and there's going to be a lot less asset to share amongst shareholders and debt holders than what we see on the balance sheet. When we compare the current price to the historical price fluctuations, the stock is 2.6% higher than the 1-month low, 2.6% higher than the 12-week low, and 2.6% higher than the 52-week low. On the options market, which often gives us a hint about the market sentiment of where the stock price is likely going to go next, the implied volatility is 412%, compared to a historical volatility of 131%. The put-call volume ratio is currently at 0.03. It's normal for many stocks to tend to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 576 contracts within a day versus the 30-day average of 2,000 contracts. In terms of open interest, the most recent volume of open interest has been 206,000 contracts versus the 30-day average of 171,000 contracts. In terms of the shareholder structure, institutional shareholders own about 18% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Shea Capital. It is relevant to understand the shareholder composition of a company because this helps us to determine if you should be holding the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's obviously a lot of exceptions to this because there are many great companies mostly held by retail investors as well. But that tends to be the exception and not the rule. Let's also take a moment and look at the short interest present in the stock, which is the amount of positions aiming to profit if the price goes lower. Sometimes there may be significant short amounts in the play, which means that there can be an organized shorting operation going on from institutions. The current short interest is 9% of the total float, and 55% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, with a significant chunk of it from the dark pools, it may suggest that institutional positions are taken to short the stock, and there would be potentials for a short squeeze. Based on my analysis, my recommendation is that I would recommend to enter a position in Exela and to keep at least half of your allocation for a potential retracement of 20% or so, and to hold it for at least 4 to 6 weeks. I would recommend to commit between 0.5 to 1% of your portfolio, and to split your allocation in batches of 20% at a time. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.